This is Ken Lake with MAC's Technical Market View for Thursday, February 16th. I'm going to start with March corn. A little bit of a correction here today. Don't know yet if it's the start of something bigger. Seasonally, it's probably not the time of the year for us to just simply collapse. We've still got some time for this thing to show strength. But the thing that I'm concerned about is, of course, here with stochastics actually giving us a sell signal during the session today. The most friendly thing we do see, though, is that my shorter-term moving averages are starting to cross above longer-term moving averages. In this case, the 20 turning above the 200-day moving average, long-term friendly. So that puts support back here at 367. Still think there's a chance that this thing could trade this 50% retracement line. So 387 would be our goals. A lot of us had orders today to sell 380 March corn. I don't believe any of us got our fills. So we've seen a big red candle here once we traded 380 and things turned around here. So still going to maintain a fairly short-term friendly stance on corn. Bear in mind the fundamentals do not support being friendly on corn. There's plenty of it around. Probably why we're seeing a little bit weaker basis in most of the areas here. So just be cautious here. And our recommendation is that we lighten up on old crop corn on this rally. Likewise, December corn gave us our first chances for decent hedges this past week at the $4 range. Traded 403, 3/4 today, and then made a big red candle and a turnaround here today as well. I mentioned before, we've traded above 390 in the D's contract for a while here, and that's still fairly friendly territory, and perhaps rather unexplainable when we think about the poor fundamentals for corn. Also bear in mind that with March 31st planting intentions coming upon us, the bias generally seems to be that we may not see the big drop in corn acres that we once envisioned. That would be long-term bearish corn as well. But for now, we'll run targets at 405 to 410, see where this thing goes, but must have major caution here in regards to corn going forward, and would believe that we should be hedging our 2017 production now. Switch to March soybeans. Similar patterns to other corn. We've seen stochastics or momentum indicators give us sell signals today on this big red candle. Support's going to be 1036 in the March with resistance at 1060. Long term, will this thing trade $11? Well, you know, it all depends on how the South American crop finishes and what we do with acres. If the conventional wisdom comes to pan out where we have not the big decrease in corn acres, that means we won't see the big increase in soybean acres either. So there may be some reason to be friendly long-term soybeans, but would really like to see the balance of South American production period play out here. Currently, some pretty major flooding down there, which is a similar pattern to a year ago when they had major harvest losses due to floods. So it bears watching South America. New crop soybeans traded within 10 cents of the old contract high, 1033 I think today, with 1043 being the old contract high. Trends are pretty firm here. We've been pretty aggressively recommending that farmers hedge the 2017 crop on the idea that we would have a big increase in soybean acres. And as I just mentioned, with input cost getting more in line on the corn, we may not see that big increase in soybean acres. So there could be a reason to be friendly. Soybeans, we'll say after the March 31st report going into the spring planting, or even the July 4th weekend, for example. But have some hedges on. Certainly get yourself covered in case we're wrong about all of that, because there are certainly good world supplies, good U.S. supplies, and we may see that thing fade if a weather problem doesn't crop up where we could be a little more friendly. In March wheat, we've seen this thing march right along. We're going to watch the 200-day moving average, and we'll call that support at 450. And you can envision where these two moving average lines will come together out here at about 445. So that 445 range would be another major support area, and we'll see if we can hold that support line. But we're probably going to track this 200-day moving average for a while until the 20 crosses the 200, and then I think we're going to stay above those values for the foreseeable future, just simply because our seedings are so low. Likewise, with low seedings, the July contract made a recent high today, turned around on a bit of a turnaround, but that high touched 488.75, which gets us above this retracement line. So let's look for this thing to trade about this 50% retracement line over time. The recommendation we've been giving customers is that with low seedings, we believe that this crop year could be traded similar to a short crop year, where we actually make highs at harvest time, or at least tend to go stronger into harvest time. Plenty of old crop wheat out there to lay off against any sort of strength and basis. So that's why we're still seeing big carries in the wheat market. A lot of customers with wheat in the bins that look to sell the carry work with us to see, get a recommendation on what that number would be to carry either into July or even next December, and we'll help you be able to manage those positions.